much. Okay. Okay, let me share my screen. Can you see the shared screen?
I am able to see the screen.
Okay, excellent. Okay, so let me get started. Okay, thank you so much. I want to thank the organizers for inviting me to present this paper, and I'm very excited that Rekha accepted to be discussing the paper, and I'm looking forward to our discussion. Okay, so the title of today's paper is EXIM's Exit, the Real Effects of Trade Financing by Export Credit Agencies. This is a joint work with Adrien, Karsten, and Chenzi. Okay, we know that we know that industrial policy often targets trade financing because trade is an important source of income and growth, and furthermore, trade requires financing, but private trade financing could potentially be under-provisioned, and I'm going to talk about why in a few slides. The question of this paper is there a role for government intervention? And we are going to study this question in the context of a well-developed financial market, more specifically the US, and we are going to look at the effect of trade financing provided by export credit agencies. Export credit agencies are these ubiquitous agencies that are across the countries, okay? So it's a priori unclear whether there is a role for government intervention. What are the arguments for government intervention? The argument that we have laid out for government intervention is basically a missing market argument. And what do we mean by that? From previous research, we know that trade financing by the private banking sector is specialized and it is concentrated. Because of that, it could potentially be provisioned suboptimally, okay? So the provision of trade financing could be done at a suboptimal level. Now, thus, there could potentially be a role for government because if governments are not only optimizing over profits, then they can intervene in this market, they can provide trade financing, and if they're not only optimizing over profits, they could potentially offer lower prices for trade credit. Also, it's worth noting that government has a different cost structure because they have access to different technologies, okay? However, the cons of this is that people argue that export credit agencies support is infra-marginal. What do we mean by infra-marginal? The idea is that if you take away this export credit agencies support from firms that rely on these supports, basically the firms that relied on the support are going to face reduced sales and so on and so forth. So inframarginality means that firms can substitute to private sector provision and firms are not affected at all. Now, it could be that you can argue that, look, the export credit support is not inframarginal, but it fosters misallocation. What does that misallocation mean? It basically means that it's going to benefit low productivity firms. Think of politically connected firms. So it could still be that export credit agency support is not inframarginal, but creates misallocation, okay? Okay, so these are the empirical questions that we are going to focus on in today's talk. The first question that we're going to focus on is export credit agency or ECA support infra-marginal for firms? The second question that we are going to focus on is ECA support infra-marginal for aggregate US export? It could be that ECA support is not inframarginal for US firms that rely on these subsidies, but it could be that the export credit subsidy is actually inframarginal for aggregate US export, because basically if one US firm is not exporting, another US firm can be basically substituting for that firm and be doing the exporting. And then the third question that we want to think about is, does export credit agency increase misallocation or not? Okay, and the context that we are going to use to study this question is basically the 2015 to 2019 shutdown of the Export-Import Bank of the United States, or the EXIM banks. So what are we going to do? We are going to compare firms and sectors that rely on EXIM support versus those that do not rely on EXIM support, okay? Okay, so what are the findings? The first and most important finding is that EXIM support is not inframarginal for firms that rely on this support. We basically find that on average, global sales, when I'm talking about global sales, I'm referring to foreign sales plus domestic sales, which is basically the sales item encompassed that, but think of it as total sales goes down. K and L goes down as well.
Poorya,
Yes.
sorry for interruption, clarification only. Would you mind to briefly describe why the US shut this down?
So that's a great question. I'm going to go over this, but basically the one answer, one sentence answer is political gridlock. Okay, so basically it is due to the political gridlock. I'm going to talk a little bit about why this happened in a few slides, okay? Okay, so then the second question is EXIM support inframarginal for aggregate US exports? Okay, sorry. So the channels, so we are going to find that the channels for this EXIM support not being inframarginal for US firm is exporting and financial frictions, okay? The second question is EXIM support inframarginal for aggregate US export? And then the answer to that question is no. Basically, EXIM support creates trade. And the third question that we are going to answer is, does EXIM increase misallocation? And the answer to that question is probably not. Now, we are going to only look at publicly listed US firms, but within those firms, we find that firms that have higher export opportunities and have higher marginal revenue per product of capital, think of it as a measure of productivity, were more affected, okay? Okay, so let me skip contributions to the literature in the interest of time and talk a little bit about the institutional context. Okay, so basically in the export market, there is large fixed cost to entering a new market for trade financing, and there is a high levels of asymmetric information. Hence, private market provision of trade financing is specialized and it's not competitive. So there could be a role for intervention. Now, one thing that I want to highlight is that because of the structure of this market, export credit agencies or ECAs could service a missing market. This is something that I'm going to provide some evidence suggestive of this role, and they could break even or even be profitable because this market is specialized and non-competitive, and the markups are high. Okay. Now, the Export-Import Bank of the United States, their mandate is basically to create jobs by facilitating export. They use different tools to do that. And I want to just briefly talk about EXIM's profitability. It looks like US EXIM is profitable. For instance, since 1992, US EXIM has returned net profit of $9 billion to the Treasury, and also the default rate on EXIM loans is capped at 2%. I want to, however, note that EXIM's profitability or lack thereof will not affect the interpretation of real economic effects. I just wanted to be clear about this as well. Okay. Okay, so this is basically this missing market interpretation of trade financing. So on the x-axis, I'm plotting country risk. Country risk is basically, this is a measure that is taken from this Hassan et al. Paper that basically provide annual measures of country risk perceived by any firm. And if you put that on the x-axis and on the y-axis, you take a look at exposure of US EXIM to various countries at different points in time, you see that US EXIM's exposure is higher for countries with higher risk. Okay, so this is suggesting that US EXIM is providing financing to markets that have higher risk. Okay, so this is consistent with this missing market hypothesis. Okay, this is basically a table that is confirming the results that I just showed you in the figure. Okay, so now let me talk a little bit about the EXIM shutdown. Okay, so when I'm talking about EXIM shutdown, I'm referring to two different events that happened almost at the same time. The first event is the full shutdown of EXIM for 5 months. This was basically driven by Republicans criticizing the bank for providing corporate welfare, and Tea Party was basically leading this effort. Now, this was a short shutdown, but this was the first time in the history of US EXIM that the charter of the bank was not renewed, and basically it led to the total shutdown of the bank. Now, the US EXIM Bank lost they did not have a board quorum for 4 years. And the reason that they didn't have a board quorum for 4 years is basically the US president needs to nominate basically the board members, and it has to be passed by the Senate. But the Senate at the time was Republican, and basically they decided to reject Obama's candidate. Trump becomes the president, and then when he becomes the president, he basically nominates a vocal opponent of the EXIM Bank to be the CEO of the EXIM Bank. And basically the US Senate rejects that candidate as well. And this process takes a few more years. And eventually after 4 years, board quorum for the EXIM is restored. Okay, so you can see this political gridlock playing a role here. Basically, why is this important? Because EXIM cannot approve long-term transactions that are larger than $10 million without a board quorum, okay? Okay, so let's take a look at the effect of this shutdown. So as you can see, the effect of this shutdown is really large. So the total value of new financial support goes down substantially right after EXIM shutdown. If you look at the third quarter of 2015, you see that the total value of new financial support is actually zero because the bank was literally closed, okay? And then after EXIM regains board quorum, you see that there is a jump in the amount of the amount of financial support that is provided by the bank. Okay. Okay. So now we want to look and find out did it affect the number of loans more or the size of loans more. So here I'm plotting the number of loans. You see that the number of loans goes down by 37%, but the real effect is the average size of loans. And you see that actually larger loans are more affected. This is consistent with this board quorum and the need of the board quorum to approve transactions that are larger than $10 million. Okay. Okay, so now let me tell you a little bit more about the data and what we do more specifically. Okay, so we basically have loan level data from US EXIM Bank. This is data that is available on their website. We basically look at firm outcomes. We use the CompuStat dataset. We include the foreign sales from CompuStat dataset segment file. And we also we basically have this data from this private data vendor called Datamine that has the universe of maritime export at the firm times product times destination level. Furthermore, we complement this data with aggregate trade flows from Berkeley dataset. Okay. So the empirical strategy is a standard difference in difference strategy, and our right-hand side variable is a dummy variable that is equal to 1 if firms received EXIM support from 2010 to 2014. Okay, it's a simple difference in difference strategy. There's no stagger treatment. We include firm fixed effect, industry times year fixed effects, and destinations time year. We basically take destinations from this Holberg and Moon data set. They basically scrape whether or not a company is selling to a particular nation from the 10Ks of different companies. Okay. All right. So the identifying assumption that we have is outcomes between treated and control groups would have evolved similarly absent the reform. I'm going to speed up a little bit because I think I don't have time, but basically it's a standard difference in difference assumption. So basically we are going to address it with the standard tools that we have. So this is a covariate balance. As you can see, the differences between firms that relied on EXIM support versus the ones that didn't is not that much. Once you control for exporter fixed effect and exporter plus industry fixed effects, the differences shrink even more. Okay. So this is one of the main graphs of the paper. Basically, you can take a look at the sales of treated firms versus control firms. And as you can observe, this is raw data. We're not controlling for anything. This is just the raw data plot. You can see that treated firms are clearly more affected relative to the control firms. Okay. We basically run this regression in a difference in difference setup, and basically you can see that there's no differential pre-trend. There's a sharp drop after EXIM shutdown, and then there is no recovery. Okay, and the average effect is 18%. So firms that relied on EXIM support before EXIM shutdown experienced an 18% reduction in sales relative to the control firms, the firms that did not rely on EXIM support before the EXIM shutdown. Okay, all right. So you might say that, look, EXIM firms and non-EXIM firms are different, so it might not be a good idea to compare them. We have a different identification strategy in which you can actually control whether you are receiving support from US EXIM Bank or not. We are going to rely on the fact that EXIM lost board quorum, and you need board quorum for approving transactions that are long-term and more than 10 million. Okay, so basically in this table, we are comparing firms that relied on EXIM support. The only difference between these firms is a triple difference specification. The only difference that we are exploiting here is whether you relied on long-term support or whether you relied on large loan support. And you see that firms that relied on large loan support and firms that relied on long-term support are affected more. Okay, so this is hopefully addressing some identification questions that you might have when you're thinking about this setting. Okay, all right, so we basically next look at other outcome variables. We look at tangible capital, intangible capital, and employment, and we find that all of these goes down. Interestingly, we find that there is no change in return on assets, and this basically is this basically supports this notion that EXIM is not just providing corporate welfare that increases profitability of the firms that relied on the support. Okay, all right. So I'm gonna. Okay, so basically, the main channel, one of the main channels that we have in mind is basically this EXIM support affected exporting. We look at exporting at different from different data sets. I haven't exactly talked about the particular assumptions that we're making here, but you can see that basically if you measure exporting using foreign changes in foreign sales, foreign sales goes down. The number of mentions of selling to a particular different nations goes down in the Hoberg. This is taken from the Hoberg and Moon data set, and we also find that from this data mine data that maritime export goes down. You can see that the coefficient of maritime export is actually a bit larger than the overall export, because previous literature has shown that this kind of export is more sensitive to financing. Okay. All right, so we also find that firms that are more affected are firms that are more financially constrained. We use different measures of financial constraint. We basically look at leverage, dividend, and we also take this measure of financial constraints from Hoberg and Moskimovich. The takeaway here is that if a firm is more financially constrained, they are more likely to be affected by EXIM shutdown. Okay. All right, so we do a bunch of robustness checks, and then next we take a look at aggregate impact of the EXIM support. Here we are basically looking at HS 6-digit export for the entire US. And basically our right-hand side variable is, or the exposure variable is the amount of export support that a particular product category gets relative to the total amount of export before the EXIM shutdown. As you can see, you can basically clearly see from this graph that industries that depended more on EXIM support are more affected. Okay.
Poorya, last
Yes.
3 minutes.
Sure. Okay. Okay. So the takeaway here is that this EXIM actually creates exports and it's not actually reallocating or it's not business stealing across US firms. Okay. Okay, so far we have showed that basically EXIM support is not inframarginal for firms. It affects global sales, exports, capital, and labor. We have shown that EXIM support is not inframarginal in aggregate. It creates trade for the US as a whole. And the last question that I want to spend the last 2 minutes talking about is how efficient was EXIM support, okay? So we are going to take a look at companies with high export opportunities and companies that are more productive. So we basically find that if a company is in an industry in which the export in that industry is growing, these companies are more affected, okay? So the interpretation is that if EXIM benefits firms more likely to have NPV positive projects. So it's not that EXIM is supporting industries that are not growing, it's supporting its support is actually more important for industries that are growing. And here's basically the final result. More productive firms are affected more, and this is actually saying that the EXIM shutdown actually because capital shrinks more for high MRPK firms. High MRPK firms are more affected, misallocation increases, okay? So basically our interpretation is that EXIM's shutdown increased misallocation. Okay, so I want to conclude today's presentation. Basically, export credit agencies are ubiquitous across countries, but it's usually difficult to evaluate their effects. US EXIM had large overall and allocative effects in a context where the financial market is developed, and we are also looking at a subset of firms that is large and publicly listed firms. The key takeaway here is that our paper provides empirical support for the special role of industrial policy for financing in international trade.
Thank you very much, Poorya.
Thank you.
Now let us turn to our discussion. Rika, the forum is yours. Rika Johans is from UBC. Thanks a lot for joining us. 20 minutes.
Yes. Thank you so much for the opportunity to discuss this paper. Oh, it says my screen sharing is paused. Can you see me? Why is that? I've never seen this before.
I can see your face, but I cannot see your share screen.
It's okay. It wants to share my Adobe, and this is usually not a good idea. Okay. Can you see this? Can you see my my
Yes, we can
screen?
see.
Perfect. Okay. Thank you so much for the opportunity to discuss this paper. It's been on my reading list for a long time, but there's nothing like a good discussion to make you actually dive into the details. So here is what I'd like to do with my time today. I want to sort of start big picture and kind of place the paper in what I would say is sort of a missing literature in the field on the role of trade finance as industrial policy. And I want to try and convince you that this is actually an important topic that we don't know much about. And then I'm going to have sort of one kind of major question to the authors, which is going to be about how we think about and how we interpret the results. And if there's time, I'll share some of my small econometric quibbles, but we can also do that offline later if I'm pressed for time. Okay, so I guess most of you here have received the memo that industrial policy of the form where the policymaker is actually announcing that they're doing industrial policy, that type of overt, open industrial policy is very much back with Bidenomics. But what is kind of interesting is that because industrial policy hasn't really been a particularly active field of research in economics, we are very much playing catch up to what is happening in the policy world. And there's really no better example of that than the policy that is studied in this paper. In some recent work, along with co-authors, we have shown that industrial policy actually likely never went away, even though it's being practiced at a larger scale today than what we've seen, particularly in the West, than what we've seen in a long time. And one of the points that we make in that paper is that I think, contrary to popular belief, much of modern industrial policy is heavily outward oriented. So as opposed to being sort of protectionist, a lot of the industrial policy that we see around the world is trying to get firms to compete more competitively in exporting markets. And something that is not, I think, in the current version of our paper, but that I think will make the authors very happy, is that when you break down these policy categories even further than actually trade financing, in terms of the counts of industrial policy activity that we're measuring, trade financing is really what comes in first as the dominant, as one of the dominant tools of industrial policy. Count-based measures are always problematic, but sort of underscoring the point that Poorya also made, this is, however we've cut the data, it just seems that this type of export credit agency activity that we see with trade financing is a first order industrial policy in the current economic environment. This is something that I'm taking from Poorya's paper now. This was a really interesting graph for me to see because it underscores sort of another point that is coming out of our paper that I think is consistent with what this paper is finding, which is that export credit agencies, so this is not a US phenomenon, export credit agencies around the world are pretty prevalent, but you can see that there is a very stark pattern in the data. We really see export credit agencies in rich OECD countries, and it's less prevalent in sort of poorer parts of the world. It's almost completely absent on the African continent, and actually much more absent than I would have imagined in Latin America. So For rich countries, for advanced economies, in particular, export credit agencies are one of the most important tools of industrial policy, yet we know very little, I would say almost next to nothing, about their impact. And this is where Poorya's paper comes in and provides really, I think, some of the best credibly identified evidence that I have seen, and it's deepening our understanding of the ways in which trade financing is working. It's sort of just like increasing our understanding by leaps and bounds. So I think this is a really timely, highly needed paper to understand why trade financing seems to be, why the state seems to have such an important role in trade financing, at least in the data. So I don't want to spend too much time on what Poorya and co-authors do, just because Poorya did actually an excellent and very clear job at summarizing their paper. They're using the temporary shutdown of the US EXIM Bank as a natural experiment to study the effect of what are in the literature called credit subsidies, although to what extent there's an actual subsidy involved here, as the authors acknowledge, is not 100% clear. But regardless, the literature calls them credit subsidies, so I'm also going to follow that convention here. The main finding is that EXIM's exit led to a contraction in affected firm sales and exports, and then as we just saw in the presentation, there's a bunch of other outcomes that the authors are very very carefully tracing out. What I really like about the paper is that they kind of really push kind of the bounds of trying to understand what is going on. They carefully show that the shock hit financially constrained, high marginal revenue product capital firms the most. And this does, I think, go a long way to suggesting that EXIM Bank is solving some sort of financial friction that is in the market. So, where I want to go next is to think about what view of the world are their results consistent with. And I think what is safe to say the paper is doing sort of really well is that, contrary to kind of what the worst, what skeptics kind of most fear about what industrial policy ends up doing, EXIM seems to be doing more than offering sort of handouts to a privileged few firms. So if you sort of believe in kind of the most pessimistic view of industrial policy, as this satire that I'm showing you here about infant industry protection from the early 20th century US, kind of consistent with sort of Paul Ryan's characterization that this is corporate welfare that is being handed out by the government to a lucky few. I think the paper, at least for me, did like a very good job of convincing me that there is something more happening here than kind of the most sort of worst case scenario of industrial policy. However, I think where I still had sort of a couple of questions is whether the results as they currently stand, whether those fully convince us that the EXIM Bank is helping to solve a market failure. And I think I want to be clear that I think at no place in the paper do they claim any such thing. But I think when we think about industrial policy, really what we're thinking about, or sort of the justification for doing industrial policy, is that the government is solving some sort of, or alleviating some sort of market failure. And I'm not entirely sure that the paper sort of has fully convinced me that EXIM is doing that. So here's sort of one alternative story that I kept coming back to as I was sort of thinking through the paper. So imagine that what is happening is EXIM is doing something that's productive, but it's doing something that the private sector would also do. So really, it's not sort of the Paul Ryan view of the world that we're sort of just handing out goodies. It's more the view of the world where EXIM is just crowding out private trade financing. And the reason that I think this is actually really hard to sort of fully do justice to in this context is that the shock that the authors look at, this natural experiment, is ex post. It's a temporary shock. So, you know, today we know that quorum was restored. This was a temporary shock. Ex ante, you know, at the time, I'd be curious to see how the authors see this context, but knowing very little about this, the way that I would imagine this played out is that both for sort of potentially competitive or potential competitor private sector banks that are thinking of entering, and for the firms that are affected by this, ex ante and throughout, they look at this situation and they think there is a reasonable chance that this is a temporary shock. Now, this is going to be tricky, or this is going to make things a little bit tricky because, you know, knowing what we know about the way the banking sector works and the way trade financing works, we know it is costly for firms to switch lenders. And of course, we know that because this is a very information intensive industry, it would be extremely costly for another bank to come and step in, particularly if they think that this is a temporary shock and EXIM is possibly going to come back. So if, you know, in that sense, if the shock is not temporary, a different view of the world, I don't think this is not about identification. This is not about econometrics. This is about how we interpret what we're finding. To my mind, it wasn't clear that I couldn't look at their results, believe everything that they're doing, and think that what is actually happening is that firms and banks are kind of waiting and seeing whether they will want to enter the market. That this is a temporary shock, that everyone is just going to kind of swallow the costs. Everyone is just going to sort of take the costs of this shock. But if it were a permanent shock, we would see something potentially different. And I think to sort of fully convince us that EXIM is doing something that the private market would substitute only differently or only partially for, I think somehow we would either need the permanent shock that the authors don't have, or we need to sort of, or the authors need to sort of try to sort of squeeze more out of what they currently have. And I think, you know, given that the shock is temporary, given that we don't have access to a permanent shock, my suggestion would be whether you can dig deeper to answer the question of what the credit agency is doing that the market can't or won't provide. And I feel really bad asking the authors to do this, because as I read the paper, I was honestly and genuinely kind of so impressed by the fact that they're already doing sort of a lot on this margin. So, you know, the EXIM Bank, they show this, I think Poorya talked about this a little bit, it's lending to destinations with higher political country risk. So there is a strong sense that EXIM is taking the least, I came away with a strong sense that EXIM is probably taking the least profitable parts of the market. But even so, you know, EXIM is profitable, so it's not apparently obvious to me that a private sector bank wouldn't want to come in. If EXIM were to disappear forever tomorrow, that a private sector bank wouldn't come in and at least take part of these part of EXIM's business. The other thing that I was thinking about is, you know, is it about the money that is it about sort of cheaper lending or sort of below market lending rates that EXIM Bank is doing, or is it something else the bank is doing that the private sector can't? And this got me thinking. I'm sorry, I'm really silly. I haven't plugged my charger in, and of course, this is the time when the charger is about to go, so I'm going to have to do this while I talk. But what it got me thinking about is another example of a US agency that is currently in the business of giving out loans, and this is the US Department of Energy Loan Programs Office, which is dispersing a lot of the Inflation Reduction Act money. And when you look at what they're doing, part of what the Department of Energy Loan Programs Office is doing is that they're vetting these clean energy projects from a scientific point of view. So there's this really nice recent New York Times article that talks about kind of what exactly the loan programs office is doing. And one of the people that receive, one of the firms that is receiving some of these loans talks about how it's actually not about the loan that you get. It's a lot of what is coming with receiving one of these loans is that you're getting sort of the seal of approval from one of the most sophisticated technical organizations in the world. And so if I ask the question here in this context, what is it that the DOE has that the private sector doesn't have? What one story that you can tell is that this office has a network of scientists and experts at the Department of Energy that has sort of unique scientific expertise to vet these projects. It's not necessarily sort of just the money that's being given out. There is also, and I think actually Poorya talked a little bit about this, there's also some sort of niche technology, some unique technology in this case that the government seems to have. There's this new green technology that is hyper speculative, and you have scientists at the DOE who understand this project in ways that private financial institutions won't. This is actually part of the service that they're providing. So if I want to tell the same story with the Department of Energy Loan Programs Office, then a story that I could tell is it's actually not about the money that they're giving out. It's that they have some specific technology that the private sector doesn't have. They have this unique expertise to be able to vet projects in a way that this expertise doesn't exist in the private sector. So back to sort of what I was talking about before, my question is, can you do more? And I do realize that this is like, I'm really pushing you guys to the limits of what is possible with the data, but is there some way that you could kind of get a better sense of what the unique thing is, that what is the public component coming out of the EXIM Bank that the private sector can't do? I'm not sure how much time I have left. Let me just put up some of the econometric questions or some of sort of the implementation questions is probably a better word.
You actually have 3 minutes, please.
Perfect.
3 minutes.
Okay.
Enough? Yeah.
Great. I just put these up. I'm going to send you sort of the annotated version of the PDF so you can see the more detailed comments. Perhaps they're more helpful for you. A couple of some of the bigger things that I was thinking about is that the way I understood it, your baseline sample are the set of firms, are the full set of firms in CompuStat, some of whom, potentially many of whom, never export. And so given that you're only eligible for EXIM support if you're an exporter, to me, it would have seemed more natural to think about sort of the base sample as being the set of firms that export ever during this period. And we know that exporters and non-exporters are different in a variety of ways, so you can kind of see where I'm going with this question, I think. The other was the definition of exposure, which I also was thinking about in the sense that, like you say, after quorum is restored, the treated firms, the firms that are sort of plausibly missing out on loans that they would have received are the ones that are trying to get these big loans. But my understanding is that your sort of baseline definition of EXIM exposure is, have you ever sort of had contact in the pre-period with EXIM? It would seem to me more natural to have exposure defined based on, are you getting big loans? Are you reliant on EXIM for these big loans that you won't have access to? And that then also made me sort of think about one final assumption that I think you have in how you define treatment that's kind of implicit, but something that you can actually test, which is that it would be good to see that before the shock happens, firms are sort of taking out multiple of these big EXIM Bank loans, because really the idea in the way your treatment is defined is that you're exposed if you've taken out a loan before, and that would make you more likely, or that would make you reliant on these loans, but that then you can actually show this. So I felt particularly torn today about sort of spending so much time talking about questions that this paper raised, because I really want to emphasize that I think this is a really important, carefully, very well executed paper on a very important question. You know, we live in the social sciences world where we use the data and the natural experiments that life provides us with and that reality provides us with. Of course, there's always, you know, ways to make things better in like an ideal world. I think the authors have sort of squeezed out of this a lot of knowledge and a lot of results that already advance our understanding substantially. So I made all my comments in sort of a constructive vein as to sort of maybe how to caveat your results, how to push them further. And I really look forward to seeing what the authors do next. And I would just encourage you all to keep up the great work.
Thank you, Rika. I would like to thank Poorya for a very clear presentation and Rika for very insightful discussions. Nowadays, we would like to allow as much participation as possible. So if you please show your face when you want to speak. Michael, you just showed your face. Would you like to take the lead in commenting or asking questions?
Oh yeah, sure. Thanks, Bernard. You know, I really enjoyed both presentation and discussion. I'm probably just repeating what Rika said in her discussion. You know, the missing market or the response of the private sector seems to be really important. But, you know, I just want to add one question. So, Poorya, you did not show us the response of domestic sales. So suppose thinking about two different types of firms, one type has a great substitutability between domestic market and global market, and one, you know, heavily relies on global market. And I'm thinking along the line, you know, Rika was suggesting for the first type of firms, they may, you know, see it as a temporary shock and switching back to domestic market. And in the long run, they may come back, so they don't lose much. But if you think about the firms, second type of firms that heavily rely on global markets, and then the loss is loss. You know, they don't get anything. The output is forever gone. So it doesn't really matter, you know, if it's a temporary shock, it's a permanent shock from the firm perspective. So I want to hear your thoughts on that, if you have seen anything in particular, you know, the different effects on those firms with different substitutability between domestic and global markets.
Thank you, Michael. Poorya, would you mind to just wait a little bit? I want to ask the audience. Somehow I don't see your face, but if you have a question, you can do a raise hand, or you can pop up a Q&A, and I would be most delighted to see your participation. Let me ask some question myself and make a comment. By the way, Selvin, I see that you are here too. So if you have if you would like to say something, please let me know. I would have three broad kind of comments and questions. The first one is that nowadays there is a great danger to mix up traditional and real industrial policy with another types of policy, sanctions, embargoes, whatnot. All this, I don't see them as industrial policy. They are really a negative sum game policy that is a part of the economic warfare going on. So I think it's very important that you take yourself away from that mess. Focus purely on what kind of industrial policy you're talking about. And I think this belongs more to the old-fashioned industrial policy that is easier to contain, to study, and do not get into the mess of national securities and so on. And point number two is that it is very important. I totally agree with Rika and Michael that you really have to sort out what do you mean by market failure. It's more than just about financing, undertaking political risk. The market failure is not necessarily on the finance side, but there's a lot of activities which the import and export bank does, and also the export promoting agents do. It belongs to the information arena. So I would brand what Rika said us that there exists valuable information, but somehow because of our behavior and because of the nature of the information market, you don't get to it because you may not work hard to find out what you should know, but you don't know because precisely you don't know. Okay. Then the third part is that I really strongly agree with Michael and Rika that you have to think through about is there a substitution going on, and why is financing to cause the substitution from domestic market to export market a desirable thing? It could be that without the market failure in the information arena, that maybe what you're doing is just you're promoting export, but it's substituting away from serving the domestic market. And then the last point, I'm a bit worried about your estimation of the marginal productivity of capital. I don't know how you estimate it. I think it can be very tainted. If you estimate all this based on the past of what they have done in the marginal because of the subsidies and so on, so your estimation of MRPK can be noise, can be tainted. I think. And second, why is necessarily a high marginal productivity of capital means that in this specific case means that there is inefficiency, and then why should they absolutely have to be financed to push the marginal K of productivity go down? I think it really depends on whether your estimation is reliable. I'm done. Thank you for listening. Any other questions? Do you want to respond?
Sure. So let me take. First of all, thank you, Rika, for the wonderful discussion. I was actually very much looking forward to your discussion. So you are one of the leading experts in industrial policy. Wanted to hear what you have to say, especially. Okay, so a temporary shock. Is it a temporary shock or a permanent shock? I mean, I think that's a fair comment. One thing. I'm going to say something, but it's not going to answer your question. But basically, I think the official line that US EXIM has is that you have to exhaust all other sources of financing before coming to us. Now, I don't know exactly what that means, but that suggests they're basically claiming that at the point in which you go to EXIM, this product that EXIM offers is not a substitute for private sector financing, but you could argue that if EXIM was temporarily shut down, banks could come in and then it could become a substitute. So that's I think where I want to. And then one other thing that I think we haven't checked, but we should check, is basically use some loan level databases at the bank level and see if they actually enter into markets with higher political risk in the short run. I think that would be we might be able to find something to answer this question partially. But other than that, I think one other thing that it's on our to-do list, we haven't had the chance to do it, but we need to talk with people in the US EXIM, find out what is special about what they're doing. It could be that one thing that I want to make sure that this comes off very clearly is that whenever we're thinking about government intervention, we're thinking about the government intervention is a loss generating activity, right? So I think what I wanted to make sure is that it could be that the government intervenes and it's not necessarily a loss generating activity. Now, so I'm not claiming that this is the case here, but it is a possibility. Now, your question is a very well taken question. Is this only about the reducing the cost of borrowing, or is there something above and beyond reducing the cost? This is something that we have not figured out yet. I think one way that we can think a little bit more about this, talking with industry experts, hopefully will help us understand the answer to this question. Okay, so sample of firms basically looking at only exporters. I don't think that we have done it, but the way that we deal with this is basically we have exporter times year fixed effect to address some of these challenges. But I agree with you that would be another subsample analysis that we can undertake. So you mentioned that is the persistence of loans. So if you borrow, if you have a large loan, is it going to be persistent? I don't think that we looked at persistence of large loans, but we did look at the persistence of borrowing from EXIM, because you can make the same argument for borrowing from EXIM. That's persistent. If I'm not mistaken, there is a footnote in the paper. I don't know which footnote it is, but it is persistent. We have tested for it. It's persistent, but I don't know the number. Okay, so looking at big loans only basically compare the large loans versus companies that are and put together the rest of the firms. So here's where we are gonna cut the sample a little bit too thin, because I think the number of companies that are getting the large loans, I think it's about 20% of the entire sample of firms that are borrowing from EXIM. Now, one thing that I could argue for that is potentially gonna help us is that if you borrowed from EXIM, you are more likely to borrow a large loan in future from EXIM. So this could, to some extent, be a way of capturing whether you're going to get a large loan or a long-term loan. But I agree with you that in an ideal world, we wanted to only look at those loans that are affected for 4 years. And I think that that's a very valid comment. Okay, so domestic versus foreign sales market. Okay, so at some point we looked at this. Now I forgot what. So we looked at whether firms that were borrowing, how did their domestic sales change relative to foreign sales, and I don't think that we found much there. So we weren't looking. So I think some of the ideas that you had is looking at firms with looking to see there's heterogeneity between firms that have a lot of foreign sales versus firms that have very little foreign sales, and see if this affects the result. This interaction we didn't look at. What we looked at, and I don't think that we found anything. Now I have to check this one more time. We looked at domestic sales as an outcome variable. We didn't look at this interaction, but I think this is a very valid point in that we should basically explore this heterogeneity a little bit more. One thing that I didn't
what do you
have
find from the domestic sales?
We didn't find much. We didn't find much effect, basically.
But that itself is a useful piece of information, isn't it?
Okay, fair enough. Okay,
I mean, not that you have to find something. The key here is about substitution between domestic and foreign sales.
Yes, fair enough. Okay, so I mean, I have to take a look at.
The problem is really your experiment you start with. They are all subsidized before, so you do not have a clean control, a clean prior.
I mean, again, I agree with you that you know, it's a difference in strategy. I agree with you that, you know, if it was the case that, I think your comment about MRPK and the fact that MRPK is going to pick up some effects of this financial support if we are looking at it I think
no,
that's
it's more than that. MRPK could be, I don't know how you estimate it, could reflect risk premium.
So the
big question of a market failure is, why do you want to subsidize undertaking political risk? Why? What's the reason? What's the market failure with that?
Okay, so if you think that banks, so if it's a non-competitive market, then you can potentially intervene in a market. So if you take the approach that banks have exhausted all positive NPV projects, then you can intervene in a market. So if you take the approach that banks have exhausted all positive NPV projects, then you can intervene in a market. If you take the approach that banks have exhausted all positive NPV projects, then you can intervene in a market. If you take the approach that banks have exhausted all positive NPV projects, then you can intervene in a market. If you take the approach that banks have exhausted all positive NPV projects, then you can intervene in a market. If you take the approach that banks have exhausted all positive NPV projects, then you can intervene in a market. If you take the approach that banks have exhausted all positive NPV projects, then you can intervene in a market. If you take the approach that banks have exhausted all positive NPV projects, then you can intervene in a market. If you take the approach that banks have exhausted all positive NPV projects, then you can intervene in a market. If you take the approach that banks have exhausted all positive NPV projects, then you can intervene in a market. If you take the approach that banks have exhausted all positive and any projects that is left for the government to undertake is negative NPV project, that I agree with you. But if you think that banks are constrained, they're financially constrained or whatever, they have not undertaken all positive NPV project, it could be a role for government intervention.
No, with the unconstrained bank will still give you differentiated supply of capital depending on the perceived risk of your project.
Okay.
We all know that. This is finance.
I mean, okay, so I don't know if every single bank enters every single market. I think this is not an accurate description of this market. You can take a look at Philippe Schnabel's 2023 JF paper. They basically claim, and they actually show this, I think they're using data from Ecuador. No, sorry. They're using data from a South American country. But basically,
yeah, but those countries not the same as the U.S. The capital market development, I mean, they're not comparable.
So I agree, but I think it's not obvious that every single bank is basically catering to every single market. I mean, if you show me evidence that it is the case, that's yeah. But anyway,
but the argument is not about that there's none. The argument is why that missing the market is market failure. Why? It may be because the risk premium is really very high. We don't naturally want to finance that. And why is that market failure?
I mean, okay, I mean, I'm going to repeat what I just said. It's, you know, if you think that the number of projects that a bank can undertake, and what I mean is entering a market with a high political risk, that's one risk, then that's one market that the bank can enter. If the number of projects is limited, they're just going to pick up the high NPV projects. This is going to be a low NPV project, but that doesn't mean that it's negative NPV project. But yeah. Okay.
Well, we'll talk.
I have to think harder. Okay.
Yeah.
Sure,
I will
sure,
give
sure.
you your time. Yeah.
Okay, yeah. So again, I mean, I think there could be, it's because of, you know, having lower costs, but on top of that, it could be that, you know, they have some experts that banks do not have access to, and so on and so forth, like the example that Reka was talking about. But this is something that we have to think about harder. At this point, I don't have a conclusive answer to this question. Yes, okay, so to your going back, this is more of a traditional industrial policy, and this is not, yeah, it's actually interesting because I think US EXIM now has a special chapter devoted to China and how Chinese companies are going to benefit from it. But at that point in time where we are looking at it, this is not the case. But you're right in that actually that actually ends up showing up in US EXIM's charter later on. Yeah. Okay. So that's pretty much what I wanted to talk about. I don't know if is there anything I missed.
Well, thank you for, and sorry I interrupt you. So let me check the chat box. Okay, I don't see raise hand, I don't see chat box messages and so on. So I guess we end up finishing on time. I would like to thank the presenter and the discussions. And Michael, you know, thanks for your very meaningful participation. This is a very enlightening, stimulating discussion. I want to thank Jiang Xiaoyan and Wang Shi, the PBOC, PBCSF for hosting the seminar. And I would like to invite you all to come back on April the 18th, because our own Michael Song is going to present a very, very, very fascinating paper. Michael, will you mind to tell us the title? Mandarin.
Thank you for promoting our work, the Mandarin model of growth.
Yeah. So, believe it or not, Mandarin model of growth. It's really very interesting. It's a fascinating paper. Thank you very much to everybody. I appreciate your help, appreciate your participation, appreciate your support. And also to the ABF Yao team for thanks for having us. Okay. Bye, everybody. Are we done?
Thank you so
Yes, we
much.
are. Yeah. Thank you.